Now, with my guest, Eric McLaughlin of BNP Paribas Investment Partners, we will examine prospects for investing in smaller companies. Supporters of smaller companies, Eric, claim they nearly always offer stronger growth prospects than larger companies. What is the reason for this? Is this due to the innovative nature of smaller companies, the research they're able to do into their products?
It's a combination of factors, probably, that have allowed small cap companies to grow more quickly. I mean, just the law of small numbers allows a smaller company to grow more quickly than a large cap company. If you're a $50 billion large cap company, it's difficult for you to double your sales in a year. But with the small cap companies that we research and invest in, it's much easier to have, to start from a smaller base and grow more quickly. Plus the fact, I mean, you talked a little bit about the innovative nature of small cap companies. We find that to be very real in when we're investing. So we find companies that are looking at in this quick changing economy, whether we're talking about a technology company or a biotech company, companies that where oftentimes the founder is still involved. Small cap companies are very quick and flexible enough to take advantage of market opportunities that large cap companies just can't take advantage of. We also find with small cap companies really the ability to be focused on a single product, whereas large cap companies are often very diversified. If you're looking at a large cap biotech or a large cap pharmaceutical companies, they'll have multiple different revenue sources, multiple different products that are in different stages of their life cycle. But with small cap companies, they're oftentimes a pure play on a new technology or a new drug or treatment that is out there. For example, in the technology area, a theme we've been investing in is cybersecurity. Now, in large cap companies, oftentimes there are large cap software companies that have a portion of their revenue being driven by cybersecurity, but it might be one of 3 or 4 or 5 different products or lines that they have as revenue sources. When you're talking about a small cap, if you want a pure play on the theme, there are small cap companies that's all they do, is develop software to protect data networks from hacks or from security issues. So small caps really allow you to have that pure play on a theme.
And these cybersecurity, biotechnology companies, the rest of these innovative firms you speak about, are they covered substantially by analysts in this information age? Or is it still a case of the olden days when only the telecoms, the utilities had the big coverage and the smaller non-household name firms weren't really on the analyst radar?
There's a saying on Wall Street, which is that 80% of the analysts cover 20% of the stocks. And that leaves a very wide number of stocks that are undercovered. It's one of the reasons that small caps are so compelling, because they're less efficient. We'll oftentimes, in looking at a company, have 1 or 2 different analysts who are covering the company, and that opens up opportunity, but also has risks as well. It requires the investor to do a lot more groundwork to get to know the management even in a deeper way, because you can't rely on Wall Street coverage of these individual names. So there's a level of increased risk that goes along with investing in small cap companies. But for a research team that's willing to do the work, it opens up an opportunity that's very compelling, because we can find stocks that are underinvested, where we're finding very strong catalysts that other investors haven't discovered yet. So it really provides us with a great level of opportunity to add value for our clients.
And is one of these catalysts M&A? Where are we currently in the M&A cycle, in the technology sphere in particular?
In a lot of different spheres, mergers and acquisitions have certainly been a strong driver of providing support for equity prices, and in particular in the small cap space, we've found that to be. Now, whether we're talking about larger companies looking to buy growth, or for instance, we've had a number of biotechnology stocks that we've owned be purchased by larger, more established, who are looking to buy growth. And on the technology side as well, we've had it. On the banking side, in the financial space, we've had that as well. So with interest rates continuing to be quite low, with the stock prices of equities being at a relatively high level, companies are using their stock or free cash flow that they're being able to generate to increase their dividends, to do stock buybacks, but also to keep mergers and acquisition at a quite robust level.
Our readers have been quite interested in the FinTech side as well, Eric. Is that an area which some of the small companies have prospered investing in that sector?
It is. We've seen that in multiple of our holdings where companies that can quickly react to market developments have really been able to increase their value for shareholders.
And that's a hedge against some of the people who are still scared of going into the big banking stocks. Here's a way into finance and financial technology, but with less risk than going into one of the so-called masters of the universe of Wall Street.
That's correct. I mean, we have certainly seen the larger cap names in the United States, whether you're talking about Bank of America, Citibank, JP Morgan, they continue to have an overhang of whether it's regulatory or different capital requirements, and there's constant monitoring of the too big to fail rules that the U.S. has put into place, and so there are definitely opportunities that smaller players in the market, whether they're regional banks or diversified financials or insurance companies, that have been able to move in because they're smaller, they're quicker, and take advantage of those opportunities.
Thank you very much.
Thank you.